Welcome to the Journal podcast from the Chartered Insurance Institute, a place for thought-provoking discussion from the world of insurance and beyond. I'm Christopher Shadforth, Communications and Engagement Director at the CII Group, and in this episode of the Journal podcast, we're speaking to co-founders of the Commonwealth Insurance Forum, Robbie, Lyle and Francis de Zulueta, about insurance-linked securities. How are you both doing, gentlemen?
Very well, thank you, even in this heat.
Yes, very well. Thank you, Chris. Yes.
Superb. Well, it's wonderful to have you back on the podcast again. Now, we're at this point in time, risks are increasing in scale and complexity, and the traditional insurance model is being tested, isn't it? So in this conversation, I really want to explore how the market's responding, how capital markets are being invited to step in, and what all this means for the future of risk. Now, I should say that through this episode, we're going to be talking about a lot of data. It's all been compiled from public sources, hasn't it, gentlemen? We're not giving any form of risk or investment advice in this episode. This is really talking about the big picture situations. So, Francis, I want to come to you in the first instance. It feels like we're going through a period where risk is coming in from multiple directions, isn't it? All at once, whether it's climate and events, geopolitics, new technology risks. And the scale of the losses seems to be increasing year on year as well. So perhaps to start us off, can you give us a high-level view of the current global risk environment and what that means for the insurance sector today?
Yes, certainly, Chris. Well, Robbie and I have gone through this, and we've concluded that there are something like 9 buckets, if you like, of risk out there at the moment. So just going through those 9, the first one is climate and natural catastrophe risk. And that includes things like wildfires, floods, severe storms, hurricanes, which are driving losses well above $100 billion globally each year. And growing secondary perils like wildfire and hail are now causing really as much damage as major hurricanes. And this is all making losses harder to both predict and price. Secondly, cyber risk. Well, we all know a little bit about that. Ransomware, data breaches, deep fake-enabled fraud, supply chain attacks. These are all expanding faster than insurers can model them. Cyber has grown really from a niche product into a core and very fast-growing line of business. This is obviously dangerous both directly and probably in particular indirectly. The third bucket is geopolitical and geoeconomic disruption, and in that bucket we include trade sanctions, tariffs, trade controls. Trade controls have overtaken armed conflict as the main geopolitical concern. Rerouted shipping lanes, port congestion are also raising risks for marine and aviation insurers, and obviously the Straits of Hormuz is a very good example where we have an absolutely enormous marine aggregation of risk in one place.
Absolutely.
Moving on to artificial intelligence, number 4. AI is certainly increasingly transforming underwriting and claims, and is itself, of course, becoming a top emerging risks, particularly around, say, model errors, bias, longer-term unpredictable outcomes. Consulting and risk leaders now rank it really among the most significant future threats. Number 5 in our bucket of 9 is economic and financial market volatility. And that's including interest rate shifts, inflation, asset liability mismatches are now a growing concern, especially, for example, for life insurers with large investment portfolios or indeed pension providers. Moderate global growth overall and a softening labour market add to further economic uncertainty. Number 6, social inflation and liability costs. And that really includes social inflation means rising litigation costs, basically. Larger jury awards, expanding liability theories are pushing up claims and costs in the casualty lines. Some insurers are really struggling to keep up with this because the inflation risk, if you like, that they're underwriting now is outstripping what they had modelled as a loss in the first place. Number 7, the protection gap, and this is a really key point for this podcast probably, and that is the gap between insured and actual economic losses from disasters is widening. And it's widening rapidly and significantly. And it's estimated by some measures now, today, at something like $1.8 trillion, i.e. between what is available and what it needs to be available. Parametric insurance and catastrophe bonds, which is what we're talking about today, are growing as tools to help close this gap. And that particular area is growing very fast, and that is what we'll explore today. 8 and 9 is regulatory and tax change, new capital disclosures and tax frameworks, Pillar 2 reporting, evolving solvency rules, and these are all adding to compliance complexity for insurers, particularly if you're operating across multiple jurisdictions. And finally, number 9, talent and workforce transformation. As you would expect, probably there's a skills gap, and the need to integrate AI into underwriting teams is creating pressure on insurers to re-skill staff faster than most are currently managing to do. So that's our little 9 list, Chris.
I do wish we had a 10th one there, Francis. I think that would have been neat. Maybe we could get a 10th one by the end of this episode. I don't know. We will drop the music in anyway. But I mean, it's absolutely incredible. All these different risks. Is this why, Robbie, the traditional insurance market is struggling to expand to handle all of them? Is it the nature of the risks? Is it the size and extent of the risks? Is it both of those things that are causing the challenges that we're facing today?
I think that you asked a very salient point here, because it is everything which is happening, and the ability of the market capitalization to keep pace not only with inflation within its own programs, but bringing on board new insurance opportunities, and some of which have yet to be properly tried and tested. One thing which I want to almost go straight into is the reason why P&I clubs, protection and indemnity clubs, are probably one of the greater answers for what is happening today, because they can cope as an organization to help combine the risks which all the people in that class of business are facing, and they can regulate the premiums which have to be paid. And if they have a very good year and no claims, then that money goes into the next year, unlike an insurance company, which then returns it as a dividend to shareholders. And in some sense, what we're now looking at is what I would call reverse sovereignty. What does that really mean? It means where you have AI and cybersecurity, many of the organizations who are responsible, the developers of those programs, are not necessarily living or based in those host countries. And so you have regulatory problems from the start. So that is one reason why, if you look at a P&I club, and they themselves are now moving into what's known as the Rotterdam rules, having been led by the Hamburg and Hague conventions up to now. But let me take you back on the P&I club origins at the beginning of the 20th century. And it's a very good example as to what happens when the market itself doesn't have enough capital. Because in 1913, with the outcome of a war about to happen, the government started having negotiations with the insurance industry as to how much they should support vessels in the high seas who may be attacked by enemies. And actually in 1914, the government agreed 80% cover. So the private market was only left with 20% cover. But in 1917, the situation was so dire for the insurance industry, even with its reinsurance programs going across the world, it actually took on 100% of the risks of marine activities during that time. And we often think it was the Spanish waterborne agreement of 1937 which organized this, and the reason why the government took over some of those marine risks. But actually, it goes all the way back to the First World War. And if you look now at the Rotterdam rules, which the London Club, for instance, wants to introduce, and quite wisely, in my opinion, it's not only to cover the sea voyages, the land carriers, the warehouse risks, the freight forwarders as well. And this is a huge new introduction. And why that is important to look at in our new sphere of AI and cyber, because it's almost the same. You've got to have cover to protect people from outages where they suddenly lose power. How do they get that power? It's impossible that they can get all their power from the national grid. They will have to build small modular reactors or have fusion in the end to help them. A traditional fossil fuel will not actually help a continuous run of energy, which is required by the AI program. So you have that to look at. But also, you also have the risk, for instance, of the developers, the vendors, and the deployers in the AI world. The developers are people who create the AI models, such as OpenAI, Anthropic, and Google. The vendors customize the packages, and that applies to people like Microsoft. And then you have the deployers. Now, who are the deployers? And this is very interesting. Many of the deployers will be government-owned, not necessarily so much in one country, but more in another country. And that is why an actual combined P&I club to help sort out these matters is hugely important, especially when it comes to legal matters and the understanding of international law and cross-boundary investments.
Yeah, absolutely. I think the most fascinating thing in that for me, Robbie, is the idea that insurance-linked securities, I mean, I had it in my head that this is a relatively new introduction to the market, and I suppose it is in many ways. But the principles, like much of insurance, go back far longer than that, don't they? I mean, if we're talking about the First World War for protection indemnity clients, as you've described there, these new products are building on the foundations that were established back then. And I suppose that says something about the insurance market. As we've discussed before in this program, there are always different risks, evolving risks, and the market's responsibility is to try and find ways in order to match them. I mean, Francis, you were talking at the start about a protection gap of $1.8 trillion. I mean, it is absolutely eye-watering sum of money. ILS has got a role to play, and it has been increasing at a quick pace, hasn't it, in recent years? But perhaps it's worth just unpacking how they work in practice for our listeners who might be less familiar with them, because they are still niche in some ways, despite their rapid growth.
Yes. So, just understanding what an ILS actually is. It does cover a number of other names. So it could be called a cat bond, it could be called collateralized bond or whatever. There's all sorts of different ways, but let's just call it at the moment ILS or insurance-linked security. In effect, it's the insurers or reinsurers transferring at the moment specific risks, most often catastrophe risks such as hurricanes or earthquakes, to capital market investors. That's what it's doing, instead of relying solely on traditional reinsurance. So investors who buy an ILS earn an attractive yield in exchange for agreeing to lose some or all of their invested capital if a predefined disaster occurs. The best known form of an ILS is a catastrophe bond or cat bond, which is used as the model during this particular discussion. Other variants include collateralized reinsurance sidecars, which we can touch on, industry loss warranties, and they all follow a similar underlying logic, but differ in formality and liquidity, I suppose.
So, in effect, if a hurricane hits a particular city, wherever it might be in the world, and either the city or the inhabitants of that city have taken out a policy with an insurer who has then taken it to the capital markets and said, will you cover the payouts in the event that this hurricane hits? It might be the case that those in the capital markets get zero of their money back.
Correct. That's exactly right. Or, some or whatever it happens to be.
It must be a very healthy and attractive rate of interest then that those individuals, that the capital markets are receiving. Do you have any data on what the returns are on these sorts of products?
Yes, we do. I mean, it's averaging out. It obviously does depend on numerous different things, so it's hard to give a precise figure. But we think the ILS Advisors Index is showing something like a 40.10 cumulative return from January 21 to November 25, with 2025 alone delivering on average about an 11.7% return. And that's information from the Swiss Re Cat Bond Total Return Index. And that's helped by fairly high running coupons and limited loss activity. So, yeah, I mean, it's an appealing class. And as a result, investors, that is, are coming into it more and more. And they are, of course, these bonds, I should have said, are limited in time. It could be, 2-3 year bond or something like that. So obviously, if there are no losses, then the investors have the opportunity to reinvest in a new bond. And the reinvestment rate is very high indeed, because the return rate from the figures I've already given you is very attractive. And it's in theory, at the moment, but we'll come on to that, in theory uncorrelated to the capital markets in any other way, because a hurricane is obviously not the same as a stock market crash of a certain share.
Absolutely. So if you're looking for diversification of risk, well, let's face it, most people want some diversification within their portfolio. This is something outside of the norm.
Yes, exactly. And, relatively liquid and all the rest of it, depending on the type and the mix of risk within the particular bond. Clearly, if it's, a single hurricane or something like that in a single country, that's easy. If it's a multinational mixed risk bag, it might be very different in terms of payout, because, of course, it's going to be a lot more difficult to determine what the loss was, when, and therefore what the return might be.
Well, it is a really clever innovation within the market. I'll come straight to you, Robbie, that the idea that they're packaging up different types of risks in order to reduce the potential for that 100% loss, if you like. But Robbie, you had some thoughts on this.
Well, yes, absolutely. I mean, actually, what France has just been saying is absolutely true, but it's also very good for the policy holder, whether that is a government who's taken out an insurance through, say, something like the Caribbean catastrophe risk insurance program, or indeed Jamaica straight up, or individual householders. Why? Because, yes, one event like a hurricane, it's happened, and you can see the immediate material damage. But what you can't tell for a couple of years is the consequential loss, the business interruption. How much has that impacted on economies of the household all the way through to the government? And that's one of the reasons why cat bonds are so good to support the insurance market, who in itself may have limited time periods, like a year or sometimes 2 years, to cover an insurance risk. But the ILS market will be able to carry on protection beyond that particular time. And I see this in particular very important for the development of cyber and AI insurance, because you actually don't know sometimes when you've had a hit, when somebody has done a malfeasance against your program. It could take weeks, it could take even a year to find out that somebody has been putting a phishing exercise, a deep fake fraud, or moral theft and prompt injection into the program. It's very difficult to look at that throughout the whole year and across the whole world. So that's why ILS is so good, and they do deserve the return on interest, because it saves the insurance industry digging too deep into its own capital base.
Well, there's a point that I want to pick up with you both. So is this development of catastrophe bonds, ILSs, in addition to the existing reinsurance market, or are we seeing some substitution? So this is not additional money coming in, it's a substitution, or is it new money to the market?
So definitely it's an addition to the market, because you're introducing capital, which can be more easily available for the people who are putting in their claim. And there's no way that an insurance company, if we suddenly have a catastrophe, it really is very difficult in the middle of the year to suddenly find extra capital unless you've got this particular layering of insurance which I call lag of insurance, which is a help to the traditional markets.
Very good. Now, I saw a statistic that suggested that these catastrophe bonds are now around, I don't know, a fifth, 17, 20% of the available reinsurance capital out there. Is that the figure that you've got in mind as well?
Yes, absolutely. And it really is that, which is an extraordinary development over the years. And I know Francis has some very good statistics on that. Francis, if you want to add.
Yes, I think you're right, Chris. I mean, the total outstanding capital at the end of Q1 2026 in the ILS market was $63.9 billion, up 4% from the end of 25. And that's after a record $6.7 billion of new risk capital issued in that quarter alone. That followed a record-breaking 2025, where $24.7 billion in new issuance for the year came in. And that is the highest annual volume in the developing ILS market's history. So that's pushing outstanding notional to just under $60 billion by year end, up from $48 billion at the end of 24. The ILS includes non-cat bond structures, collateralized reinsurance sidecars, industry loss warranties, life and mortality linked deals, but cat bonds are the best tracked segment. And the figures above refer to that segment specifically. I've given you the average return figures already. We've seen 15 first-time cat sponsors in 2025, and that includes German and Israeli earthquake, Asian typhoon, and earthquake risk, and new entrants are joining all the time. And we've also got product innovation growing in casualty, specialty, multi-line sidecars, new ILS-focused startups, managers, and the emergence of the first cat bond ETF, which I personally think is quite a significant development because exchange-traded funds are enormous as a market capital instrument, as we all know. However, there's never been, up until now, a way of retail investors accessing ILS or the ILS market, but now there is. And so ETF access is available. I'm not going to recommend any particular firm that does it. You can look it up if anybody's interested. I'm sure Google and so on will give you the answer to that. But anyway, just touching, if I may, Chris, briefly on one element of this is what sidecars are, because people might get a little confused by that. The sidecar market it's the fastest growing segment and diversifying beyond cat risk. And it reached 10 billion by mid-2024, 40% year-on-year growth, 17 billion by 2025, and a 19.6 billion by September 25, up roughly 183% since 2023. And sidecars now represent about 16%, 1/6 of total alternative reinsurance capital of 124 billion. And crucially, and reason I'd like to raise this one is that growth is no longer just property catastrophe. A genuinely new 1.7 billion casualty sidecar segment has emerged, driven by improved pricing, higher interest rates, and investor appetite for long-dated investment floats.
So this gives you the opportunity, as I understand it, to take a share of the risk rather than being the sole entity that's exposed to the entirety of that risk bucket. Is that what a sidecar is, or have I misunderstood, Francis?
No, it's the other way around, in the sense that a sidecar allows people to invest in a bucket of risks, if you like, and you can put them all together, and it boosts the capacity of the insurer to underwrite those risks.
Oh, okay.
And both the insurer and the investor share in those risks, as opposed to transferring the entire risk to the capital markets. So in some ways, it's a more comfortable place, if you like, for investors, because otherwise they're standing alone on a single risk. In some ways, it's worse because they're muddling it up with a whole load of other potentially casualty risks. So it's a bit of both. And I think people have to be careful with this, because hitherto the whole ILS market has really been driven by single risk events. hurricanes, earthquakes, storms, floods, whatever. This new evolving area, firstly, is broadening the risks, and secondly, is bundling the risks. And doing both of those things is different in terms of hitherto pretty good returns, and may produce significantly better or worse returns.
One of the peculiarities of the last financial crisis, 2007, 2008, when I was working at the Bank of England, was collateralized debt obligations. And the challenge back then, as you'll be aware and familiar, was the idea that risk was being pulled into buckets that people couldn't easily identify. And then you'd have CDO squares where the CDOs were then bundled with other CDOs into bigger buckets, and they were being sold on the market. I don't get the impression from what you're saying that we're at this point yet, but I'm just wondering what your thoughts are on how you can monitor the risk that you're exposing yourself to once you move away from a single catastrophe like a hurricane in a named country, or from some other disaster that you can specifically identify. Do you get any sense in the market that there are concerns about that? I mean, perhaps not, because the demand is just there at this moment in time.
Well, I think, most insurers, certainly Lloyd's syndicates, to take but one example, have written multiple lines of business for decades and bundle those up and reinsure them in the traditional reinsurance market. And I've done that for decades. So I don't think that's any particular departure. Of course, the departure is there for the investor in a specific sidecar who isn't specifically a reinsurer per se, but has gone through a sort of transformer pool of special purpose vehicles in order to invest in that in the first place. So I don't think any of that is particularly new. But of course, the complexity of risk today and the increasing move towards connectivity of risk pools, risk silos, if you like. I mean, if there's an analogy to be drawn, I might say hitherto the market's historically insured single trees, if you like. It's now being asked increasingly effectively to insure the entire forest, not knowing quite where the fire might break out, but knowing that the entire forest might burn down. That's perhaps the analogy I would bring, and clearly the risk shift within that sort of analogy, boosted by AI in particular, is potentially unknown.
Absolutely. And actually what needs to happen, somehow, there needs to be a public incident database for many of these new risks. And we need to persuade the developers, the vendors, and the deployers to actually be honest and tell us when there has been a data breach or whatever, so that we can actually fully understand what the issues are. For instance, if you look at the cybercrime issues at the moment, Jaguar Land Rover alone lost 1.28 billion, and that was largely supported by government intervention. But 43% of all United Kingdom businesses, which is 612,000 businesses altogether, actually suffered from an attack last year, a cyber attack. And that needs to be quantified. And that's why I think actually Protection and Indemnity Club, as a way of looking at risk, is actually rather beneficial. And I think underwriters will be helped because they can then reinsure aspects which actually fit into their own books, whereas some other risks don't fit into their books and can be placed elsewhere and ultimately covered by the ILS market, who are obviously going to benefit from a higher return over a period of years. But it does require some very careful crafting. But the other reason for that is it will prevent too many legal cases. What you don't want is endless legal cases being fought over by lawyers who are actually distorting the claims payments by actually adding huge legal costs, which may be unnecessary if they're run through a protection indemnity club, rather similar to how Chartered Insurance Institute makes sure everybody has the same access to rules and regulations and examinations. And that is so important, because otherwise law courts are going to be completely confused by what is a claim and what is not a claim. Where does that claim come in to an insurance claim? I mean, the fact is, you could have a disaster because of a lack of energy. You could have a disaster because some rogue element has decided to do a deep fake fraud. So the insurance is attacked from many different directions. And that's why you need to have an overarching body who can actually see how to protect customers better. And customers are huge and customers are very small. If you look at a Singapore hub, for instance, you'll find that the most people will ever be able to get is about £250,000 in value. And that satisfies an enormous number of SMEs, but certainly doesn't come anywhere near helping the bigger global corporates. But on the other hand, somewhere like Singapore is an extremely good place for a hub, which can help, say, the London market or the New York market understand where the potential threats are coming from.
So who populates these bodies then, Robbie? Who would be the decision makers and those that would put on that public database that you've talked about, that an event has occurred and some sort of payout is required? Where does that come from?
Well, that's a very good question. I think you have to involve particular universities to help structure how things are collated. And I would strongly recommend a very good conversation with the P&I clubs, because they are used to endless claims, small and large, but they do quantify their risk because they actually register all the damages and everything they have to pay out. But otherwise, you can't have composite companies competing against each other without realizing the actual global market cost.
I mean, that's the other point. This is a global market, isn't it? And with these products where you're bundling up risks from around the world rather than just being defined in any particular state, that body has got to be an international player, hasn't it? It's got to be representative of the global market.
Absolutely right. And of course, you get the free markets of America, which is driving much of the new technology. But you also need markets like Europe, which is buying that technology to increase its own ability to deal with supply chains. But also you have companies like China, and China's research is in some ways based on government directives. And how much of that government directive will actually yield the real consequences of some claims.
So are we at this point in time now, Robbie, where governments have got to do more? So we've got the market's been created, the market is growing. Is this the moment where, unless these bodies that you've just described are established, the market is always going to be inadequate relative to the potential that it could get to, simply because there's a lack of information?
Exactly. And I think every underwriter would agree they can't really price in a cost to a client unless they know what the underlying claims records are. And it's not just the client, because the client may be an SME just coming into the market, but they have to know right across the board what is the annual expectation of claims. And that's why the ILS market is so important, and why I think we do need to have a body. And I would suggest a really good conversation with the Chartered Insurance Institute sitting in the room with P&I clubs, and not just from London, but also from Singapore and elsewhere, to really gauge how big the market's going to be and how it can be developed properly with reinsurance. And from the ILS market, you will get other people reinsuring ILS risks as well in the end. And that probably is often a government. India will probably do that, or Pakistan.
Very interesting. Francis, what do you make of the future of insurance in the ILS market? What does it look like in your eyes?
It's obviously a highly developing area. It's probably one of the most interesting areas of the insurance market globally. Market-wide loss ratios are pretty good. Historic loss ratios so far, anyway, has run between 2.7 and 3%. The expected loss ratio generally is about 2.45%. And recent events, last year, cats and all the rest of it, have still not broken this pattern. In fact, if we look at the LA wildfires as an example, they came in at about a $40 billion loss. The resulting cat bond impairments was only 250 million. That's really interesting because what that means is, of course, that the cat bonds work, and they work in the way they should work, and they work at the level they should work, i.e., to your earlier question of where they fit in the structure, at the top, usually. And that loss ratio is obviously liable to change in the future. And interestingly, the place where it has been worse, other than single loss events like the Jamaican hurricane, Category 5 storm, which triggered a total loss of 150 million. But elsewhere, by bundling smaller losses together, the aggregate erosion effect has caused significantly worse loss ratios than single cat events. So that's an interesting one. We found that returns improved through the stress of recent losses, and they moved up from about 7%. That's for a Bloomberg US corporate bond index, and about 6% for US treasuries to 11%. So, it's a good return. And interestingly, the issuance after the cat losses of 2025 grew rather than retreated. And so the 2025 cat bond issuance reached 25.6 billion, up 45% on the prior record from 122 transactions, including, as I mentioned earlier, 15 first-time sponsors. And you might ask whether any cracks showing in all of this. And interestingly, the wildfire risk, US wildfire risk, wasn't stopped. It was simply repriced. And now the price is 6 to 8 times their estimated loss probability, compared with previous multiples of just 2 to 4 for better understood risks, such as, say, US windstorm.
And that's part of that. Must be part of it, though, Francis. And it also picks up on what Robbie was saying there. In an evolving market where the players are just dipping their toes into the water, perhaps for the first time, these things are going to naturally evolve and change, and we shouldn't be at all surprised by that.
No, I think that's absolutely right. From 2025 really just appears to accelerate the market's evolution rather than
an appetite
denting confidence in it, and spreads expected to probably tighten in 26, partly because investors did not suffer any major losses. And issuance is likely to increase with the rates of return. The wildfire experience, I think, is reshaping deal structures. And one fund manager suggested that wildfire exposure was historically bundled with earthquake and hurricane risk. And now, because the losses have become significant enough, it's become unbundled rather than bundled on a standalone basis risk going forward. So, losses can have a good effect in terms of structuring. So unbundling rather than bundling.
Really, really interesting. Well, look, gentlemen, it's been another fascinating conversation. We're almost at the end. Robbie, any final words from you?
I think we've covered quite a lot, and I'm sure our next podcast will expand further what we've been discussing today. But there's been a fascinating time talking about the development of the market.
Brilliant. Thank you, Robbie. And Francis, anything further from you?
I think a big theme coming out of all of this is this, and that is that risk convergence is no longer speculative. Back to my analogy of the single tree in the forest. Multiple independent surveys describe AI, cyber, climate risk as compounding one another rather than occurring independently. So ILS's next major test will not be whether it can absorb a bigger single cat, because it's proven, as we've seen, that it can. The test will be whether its risk models, capital structures, and trigger designs can keep up with risks that no longer stay inside the single peril boxes that the market was historically and is historically built around.
That's a great synopsis of this program, Francis. Thank you so much. Well, we're going to leave it there. As Robbie quite rightly says, we'll be back for another episode with Robbie and Francis later in the year. But thank you so much for listening to this episode of the Journal podcast. You can find useful links in the show notes and related articles on the journal website, along with further podcasts, many of which can also be logged to CPD directly on the site with just one click. If you enjoyed this episode, please like, review, and subscribe. Until next time, goodbye.